Hello traders, in this video we will take a look at different ways of how traders analyze the markets. There are two types of analysis that you probably know: technical and fundamental analysis. Those are the most popular that traders use, either together or separately. Besides that, there are two more types of analysis that are not so often talked about: sentimental and statistical analysis. We are going to cover all four of these and take a look at some pros and cons of them. Technical analysis. Technical analysis is based on historical patterns and behaviors of given instruments. When traders are using technical analysis, they look at historical price development and based on that decide possible future price movements. One of the key arguments of technical analysis is that tools such as support and resistance, Fibonacci numbers, pivot points, or moving average are watched by a lot of investors, so the price levels attract a lot of supply and demand. But because there are no two traders in the world that are 100% same, technical analysis tends to be very subjective. As we already mentioned, there are a lot of different tools and patterns traders can use. Usually there are two main camps of traders: those that use different indicators and those who trade pure price action. And of course, some traders use a mix of both. Most popular indicators are the moving averages, MACD, RSI, Ichimoku cloud, or stochastics. They are usually based on different types of moving averages and give traders signals that are based on previous behavior. For example, RSI indicator shows overbought and oversold conditions in the chart. It looks back at price development and determines if an asset is too expensive or too cheap. On the other hand, price action traders use different candlesticks formation or levels of support and resistance, which they draw on the charts themselves instead of looking at any indicator. They also use different patterns such as head and shoulders, cup and handle, triangles, or flags to determine future price movements. Main pros of using technical analysis are that it is often easier than fundamental analysis, as everything you need is right in front of you at the chart. It is fairly easy, gives all information to all traders, and gives precise entry, stop loss, and exit points that can be based on variety of technical things. Cons of technical analysis is that markets don't often behave in a textbook manner. Due to a lot of different factors that happen in the market, technical levels are often not that accurate, which cause traders oftentimes getting stopped out before the anticipated move. Besides that, a lot of technical indicators are lagging behind the price, so you often get signals to buy or sell at already established moves. Fundamental analysis. Fundamental analysis determines the value of different instruments based on financial and economical data. Fundamental analysis determines the value of different instruments based on financial and economical data. In other words, fundamental traders follow different economical, social, and political aspects that determine supply and demand. You can, for example, go long on Japanese yen against British pound based on the belief that Japan might have a better economic situation compared to Great Britain. Therefore, Japanese yen should have more value. But with markets, things are not always easy like that. Fundamental analysts have to watch inflation, interest rates, government's decisions, central bank decisions, and also macroeconomic events that come out almost every day. Their best friend is a macroeconomic calendar, which informs them about upcoming events where data releases are perfectly planned. One of the main pros of fundamental analysis is that it can be less subjective than technical analysis. It determines the value of a given instrument and can predict price movements before they happen compared to technical indicators that lag behind the price. On the other hand, fundamental analysis gives traders oftentimes just ideas, but does not signal where to enter and exit the trades. There are too many factors that can affect fundamental analysis, and retail traders are usually the last ones that get access to key economic releases. Sentimental analysis. Sentimental analysis looks at behavior of different participants in the financial markets. It examines if there are more buyers or sellers in the market. The main indicator of sentimental analysis is the Commitment of Traders Report. Commitments of Traders Report, the COT, is published every week by the Commodity Futures Trading Commission, CFTC. This report shows open position of all the subjects that have to report their position at CFTC. These are position of big institutional subjects. Every Tuesday evening, these big players report their positions, and the report is published every Friday at 3:30 p.m. Eastern Time. The COT report shows approximately 70 to 90% of open positions at futures market. The goal of this report is to provide transparency to the futures market and prevent the price manipulation. Although this report is from the futures market, we can use this information in spot currencies and CFD trading, since spot forex pairs go hand to hand with currency pairs, and the futures commodities, metals, and indices are the same as their CFD counterparts. Pros of sentimental analysis is that it gives us a very clear idea of what is going on in the market. We can find out what large and small participants are doing in a matter of minutes. But there is no definite answer there. Sometimes large players can be wrong and the retail crowd can be right. Also, when we see a large institution positioning in some instrument, it can mean that they just started accumulating a big position. So it can take weeks or months before an anticipated move happens. Statistical analysis. Statistical analysis works very closely with technical analysis, but instead of watching different lagging tools and indicators, traders use statistics of previous market behavior to develop strategies that require very low human interaction. For example, our FTMO statistical application looks at German stock index DAX and calculates in percentage the probability of price trading to different levels, such as previous high close, closing gaps, and so on. Statistical analysis is very useful as it can remove a lot of emotion from trading. On the other hand, backtesting different strategies requires a significant amount of time and dedication. Besides that, market conditions are constantly changing. So, if you backtested specific price behavior that was occurring for the last 5 years, there is no certainty that it will continue to happen in the future. So, what type of analysis is best to use? All of them. We know that it sounds like a lot to digest, but if you really want to be a professional trader, you should be able to utilize all different aspects of trading. Watching key technical levels while being aware of upcoming macroeconomic events, positioning of large players, and statistical probabilities of things happening from the past is something all professionals do. Alright traders, this is it for this video. I hope you enjoyed this video. And if you have any question or you are just interested in something, just let your comment down below. Please tell us which analysis you use. And don't forget to subscribe to our YouTube channel. And I wish you steady study and see you next time.